I'm going to go through some different points of the presentation that are going to basically get you to a point where I was, which was when I said I was done. What I mean by that, being done with the everyday or every year financial, so-called financial planning of folks trying to tell me certain ways that I should be investing my money or certain ways that I should be putting money away for the future, hoping that something's going to happen for me to be able to retire on it or use that money when I'm ready to sit down somewhere and hope that it's going to be there for me. I was done when I realized that we cannot thrive on hope when it comes to our money. We have to put ourselves in a position where we understand that, hey, I have control of our money, of my money, every step of the way. And that's what the Legacy Private Bank is all about. That's what this presentation is about, to show you how you can maintain control of your money, do the things that you want to do now, not 20, 30 years from now, hoping that the market's going to give you some kind of return. That's what this is about. So let's get started. There's my picture there. My name is Christopher Holt. I have my partner online here as well. Her name is Rashonda Taylor. I'm located in Florida, Orlando area. She's actually in Missouri, but we work all over the country. So no matter where you might know somebody, we can work with them. If you see some benefit to other folks that you may know, that, hey, you may want to get them to understand what this is all about. All right. So as we go through this presentation, what I want you to keep in mind is that there is a problem in America, and it's not so much what we don't know. It's what we think we know that just is not so. So we've been told a lot of different things when it comes to financial planning or investing our money. And some of those things it's just not so, just not real. So, and I'm going to get through that point by point here as I go, and I'll tell you a little bit about myself as we get going in this. I have been in financial planning or financial services in some aspect or another for over 30 years. You name it, I've probably done it in terms of financial advising, from investments to mortgages to banking to insurance. I've done it all. So when it comes to understanding where some of these components I'm about to tell you, is not just me telling you something that somebody told me. I'm telling you something that I lived, something that I used to tell people what's going to happen with the markets, or something that was told to me that this should work this particular way. And I tried to do it and tell that to other people and realize, whoa, wait a minute, that's not exactly how that works. So keep in mind, you're talking to somebody here, you're hearing from someone here that has some different experiences in life from all aspects of it. Some of my history, other than being in financial services, I was also a firefighter here in Orlando, Florida for 16 years. And people say, well, how did that combination come about? How did you go from being in financial services to becoming a firefighter to now you're back to being, actually, I never really left financial services, but now this is your full-time thing. This is where you are. Well, it's probably because of the people telling me something that was some way and it not actually working that way. That's probably the reason why that transition happened the way it was. But there's a story behind that 16-year period of time in my life. I'm going to get into that as we go through this presentation and why I said, okay, I'm done at the point that I was done. Okay. Topics today, we're going to talk about the average American household. We'll get into taxes and qualified plans. We'll talk about how banks work, because being Legacy Private Bank, it's all about banking and showing you how you can become your own bank. Okay, so we need to understand, how do banks actually make their money as they go forward? And we'll get into the private banking system itself, the actual vehicle that we're using to get people to the point of where they're able to now operate within a system. They can have total control of their money and do the things that they want to do now within your life and benefit from doing that, just like the banks do. Okay? So let's talk about the average American household first. Where is the money going? 33% of every dollar that we earn as an average American goes toward taxes. Now, that's not just income taxation. That's talking about the cable tax, the tax on cable, the tax on gas, oh, I didn't know there was a tax on that tax. That's all the taxes that are out there. Interest is 34% of every dollar, or 34 cents of every dollar goes toward interest that is being paid out. And that can be student loans, credit cards, any type of borrowing that you're doing. The average is 34% total that we're paying out of the average American's pocket. That's going 34% or 34 cents of every dollar that's going out to these institutions out of our pocket into theirs. Okay? That leaves 26% or 26 cents of every dollar for lifestyle. And that's just talking about the amount of money that you may have to go to the movies or you just going on vacation. 26% of every dollar is left with that after taxes and interest that you are paying out as an average American. That leaves 7% for saving or putting money aside for the future, so to speak. Okay. But of that interest, and I want to come back to the interest piece because that is really what's most important and the piece that we have to look at in terms of understanding how you can actually grow your wealth and sustain your wealth to the point that you can create a legacy for yourself and your family by understanding where interest is being paid out and how you can capture interest from other entities or vehicles that you may be paying out right now today. So right now, there is 75% of that 34% of interest is going out, or a total 25% of your total dollar is going toward cars and housing. So the cars we buy and the mortgages that we apply towards when we own a home is 75% of that 34% of interest that goes out, or 25% of every dollar that you have is going toward interest out of cars and housing. That is a huge number because the average American household, over the lifetime of the average American, you're going to earn about $2 million throughout your life. And you think about that number, $2 million, if 25% of that $2 million is being paid out, that is over $500,000 that I'm just giving away to somebody else. What this program is about and what this concept that was taught to us through a gentleman by the name of Nelson Nash. You guys may want to write that down or make note of that name, Nelson Nash. He created this concept years ago, which is called infinite banking, okay? And he basically termed it to where he taught people that you can use the banking system just like the banks have been using us. We can earn from that system or that concept of how banks make money just like they do. But you have to do it in a particular way as we go forward, okay? I want to stay here with what I call the problem. Because what a lot of people realize and what they think of when they talk about investing, they think of, oh, what's my rate of return? Or what's my average rate of return? So what I have here is what is a 20% average rate of return. Let's just say you put in $1,000 into some investment. And in the first year, you earn 20%. The next year, you earn 20%. So that's an average 20% rate of return. Very simple. If you had $1,000 in that first year, at the end of that second year, you would have $1,440. But let's just say that $1,000 in the first year, you earned 60%. And then the next year, you lost 20%. Well, that too is a 20% average rate of return. But your account balance went from $1,000 to $1,280. But let's just say first year, market just goes crazy and the investment you went in, hey, I earned 100% on my money that first year. But in the second year, you lost 60%. Well, that too is an average rate of return of 20%. And your account balance at that time would have gone from $1,000 to $800. You would have lost $200 on an average rate of return of 20%. And if you just went crazy and had a 440% gain the first year, you lost 100% the next year, that too is an average rate of return of 20%. But your account balance would be at zero at the end of those 2 years. So we can't just focus on our average rate of return. That means nothing. We've got to understand how money actually works. We talk about dollar cost averaging over a period of time. Dollar cost averaging is for a tool of accumulation. It's designed for you as an investor to say, okay, this is a period of time where you're investing in the market to accumulate your money or your money to grow. So what saves the investment representative, and it's not, don't get me wrong, I'm not talking bad about an investment rep. I too was in this ballpark. So I'm talking about myself. What saved us when the market took turns to the downside was dollar cost averaging, because the term that we would use was, hey, this market's on sale now, you need to buy more. But what's not being realized when you're only thinking of, okay, I've got my clients now to think of, they can utilize the market to catch it when it's down, buy low, sell high, and these different things, is that there's more to this vehicle or more to investing that you really have to understand when it comes to putting your money on the market. And that is that losses hurt more than gains help. And this is very important to understand. You see, because gains and losses are not equal. Example of this is that if you lost 10% in any particular year, you need 11% gain to make up for that 10% loss. Another way of saying this is if you gained 11%, a 10% loss would wipe you out. A 15% loss, it takes 18% to make that up and get you back to break even. A 20% loss, it would take you 25% to get you back to even. And a 50% loss, those in 2008 who realized that 50% loss takes them 100% gains to get back to break even. It's very important to understand about gains and losses. They are not equal, right? The thing is that you got to expect the unexpected when it comes to investing in the market. You must know what to do when something goes wrong. So let's transition here and talk a little bit about taxation. John D. Rockefeller said the fastest way to accumulate wealth is to make sure you never pay tax on the income that you don't use. In fact, there is a book that is written, talks about what would the Rockefellers do. If you guys have not seen that book or heard of that book, I recommend you send me an email into this and say, hey, Chris, send me that book. I'll send it to you in the ebook form. What would the Rockefellers do? Talked about what the Rockefellers did in terms of how they handled their wealth, vehicles that they used. It's very similar to what we're talking about here today. And what they're doing, how they accumulated and did things for their family as they went forward. Very good book. I always recommend that to everybody. What Would the Rockefellers Do is the name of that book. Just let me know you want the copy and I'll send that to you. Okay. Future tax rates. What do you think? Do you think that over the next 10 to 20 years, they're going to be lower? You think they're going to be higher? Or you think they're going to stay the same? Most people I ask that question to think that they're going to be higher over the next 10, 20 years. I don't think I've heard anybody say, oh, I believe taxes are going to be lower. It just hadn't happened. The US dollar, do you think it's going to be stronger or weaker over the next 10, 20 years? And let's talk about inflation basically here. Do you believe that a dollar is going to be able to buy more in the next 10, 20 years, or you believe it's going to be able to buy less? Most people believe it's going to be weaker. Okay. So I have a business proposal for you. You upfront all the money. You take all the risk. You manage the business on a day-to-day basis. And 30 years from now, I'll tell you how much you owe me. Is there anybody on this call today that would want to do business with me? Probably sure not a single one of you would want to. I wouldn't have wanted to. But that is exactly what we do when we put money into government programs that defer taxes to a later date, meaning IRAs, 401ks, 403bs, 457s, anything that is tax deferred where you're deferring interest for a later time so that you can get what we call the tax deferral now. It's exactly what I just described to you. So I'm going to give you an example of why I say that. Here's an example of a $5,000 IRA contribution in a 20% tax bracket. Okay, the tax bracket is very important to understand here because that tells the government how much of a deferral they're going to give you for putting your money into this IRA or this qualified plan. If you understand the rule of 72, the rule of 72 says that if I have a particular interest rate that I'm earning, consistently earning that, I can divide that by 72 and it's going to tell me how many years it will take my money to double. So if I'm earning 10% consistently, if I divide that by 72, it would take 7.2 years for my money to double. So for the sake of this argument here, or this example, I'm going to say that our money is going to double every 7 years. And we started at age 45 with $5,000 in the IRA. And because we're earning 10%, money doubles at age 52 to 10,000, then doubles again at age 59 to 20,000, and then doubles again at age 66 to 40,000. Now, I just told you what you get in an IRA or anything that you're deferring taxation later, you get a deferral. Okay, that deferral is where if you're in a 401k, that deferral actually shows up in your paycheck. Because if you're putting money into a 401k, if you're working for someone, it's like you're putting in 1,000, but in your paycheck, it shows that you actually maybe put in 800. So that difference of money is the deferred taxation that you have based on your tax bracket. But what do most people do when they get that little extra that they feel like they have? Like, oh, okay, wow, I put this money over here, but it doesn't show I'm actually putting in 1,000. I'm actually showing that I only put in 800 based on the amount of money that's in my paycheck. What do most people actually do with the deferred money? They spend it. Yeah, but in this case, we're going to say you didn't spend it. You did what nobody does that I've ever seen, is they take that deferred money and apply it back toward the fund that they're earning all this interest on. So in this case, let's say that is $1,000 because in a 20% tax bracket, if you put in 5,000, that deferred money would be $1,000. Let's just say that you're going to reinvesting that in because you want to take full advantage of this 10% growth that you have every year. So that 1,000 grows to 2,000. That 2,000 grows to 4,000. And that 4,000 grows to 8,000. Now you're at 66 at this time of age. And you're saying, okay, it's time for me to retire. I'm going to go ahead and take this money because I want to go on a trip, do some traveling, want to do some things with the family. And you just want to take this all lump sum. What is the tax on the $40,000 that you've earned inside of this qualified plan in a 20% tax bracket? I'm going to tell you, don't worry about it. It's 40,000 times 20%. The tax is $8,000. If the tax is $8,000, but the government allowed me to have a $8,000 deferral over that period of time, please tell me where the benefit is of deferring money for a later date. There is no benefit to defer money to a later date. And this just shows you a basic example of putting money into qualified plans. Don't be fooled to believe that a deferred taxation situation is benefiting you. It does not benefit you. It benefits those who own it, which is the federal government or the company that puts you in the 401k. They're the ones who benefit from that, not you. Okay? So if taxes are going to be higher, as most people say, actually all people say, over the next 10, 20 years, is postponing taxes really a good idea? I would say not. When should we start tax planning? Actually, right now, if you are not already doing that. Everything that you do, you should be thinking of how's taxes going to affect that money? Because tax is very important. It's going to eat away at your money if you're not paying attention to it. So let's look at how banks actually make their money. How do banks make money? Basically, you put $100,000 into the bank. Let's just say in this example, they're paying you 4%. Excuse me, they're paying you 4% on your money. We know we're not getting that, but for the sake of argument, we're going to say that you're earning 4% on your. Let's say you had a mortgage. What the banks do with your money is they pay out or give loans to others to buy houses. Let's just say they're charging 7% on your money in this particular case. You sign a contract to make monthly payments back to the bank for the privilege of using that 7% to buy that house. Buy cars. They charge 8% on a car loan. Sign a contract to pay back to the bank that 8% or that monthly payment for the privilege of using the money to buy that car. Home improvements. Just say the bank is charging 9% on that, where you sign a contract to pay back to the bank the monthly payment for the privilege of you being able to do your house remodel. Or debt consolidation. Well, they charge 12%. Signing a contract to pay back to the bank there for the privilege of using that money to consolidate your debt. But let's look at this in a little more detail here, where they paid you 4%. They bring in 7% off that money that they're charging to get the mortgage, paid out 4%. That difference is 3%. On the car, the 8% loan versus paying out 4 is 4%. On the house remodel, the difference there from 9% that they're bringing in on that loan to paying out 4% is 5%. And on the debt consolidation, if they're charging 12% and paying out 4%, that difference is 8%. Now, if I ask you this question, how much did the bank actually make? If they paid out 4% and they brought in 20%, what is the actual rate that the bank actually made off these transactions? Most people would say it was 16%, and they'd be incorrect. Because what they're not realizing here is that that is a 5 times multiplier on the money that they made. They actually made 500% returns by doing this process. So what I'm here today is to show you guys is that we can do this too. My wife and I have done this. Rashonda has done this, is doing this today. You can earn 500% on things that you purchase that you normally would borrow the money from the banks by you becoming the bank yourself. There is no market return that can relate to this when you understand banking. The internal rate of return means nothing when you understand banking. 500%, and that's on the low end of what banks actually earn. Okay, let's move forward. The vehicle to use it or to actually make this happen is what is very important to get into place, because you can't just do this with any particular vehicle or financial vehicle that you're going to use. The vehicle that has to be in place is a whole life insurance policy, but it's not just any type of whole life insurance policy. It is a high cash value, dividend bearing, with guaranteed returns. It's permanent, protected with tax-free growth from an A+ rated mutual life insurance company, whole life insurance policy. You see, it has to be structured for banking. You cannot just get these types of policies from any company, because not every insurance company who offers whole life insurance will offer you a policy that you can use for banking. And I liken this to tell you a little bit more about myself in this story I'm about to tell you. Being a firefighter for 16 years, I had to retire from there. For one, I said I was only going to do 15, and I guess God said, hey, it's time for you to go. But at that 16-year period, I suffered a minor heart attack. And it's like, I'm in the best shape of my life. And here I am suffering a heart attack. It was minor, but it was a heart attack nonetheless. And so I didn't know why, had no reason, rhyme to know what in the world is going on with me. So I started researching some things like, okay, what are some of the foods that I'm eating? And it took me to where I am today, to where I'm considered carnivore. Carnivore eats mostly meat. And so people think that, oh, wow, this is no downplay on vegetarians or vegans. If anybody, you guys are vegetarian or vegan, this is not to downplay what you do. That's great, okay? I was a vegetarian for 2 years prior to me having a heart attack, first off, or vegan at least. But what I didn't know when it came to eating red meat was that there is a certain kind of red meat that you should eat. And there's a certain kind of red meat that you should not eat. Okay? They're both red meats. But there's one that's called grass-fed, and then there's one that's called grain-fed. The grass-fed meats have all the nutrients, all the vitamins, everything that you need is in grass-fed meat. And I learned this over years of eating this way and seeing the results of doing it versus not doing it prior to and what was happening with me. And I liken that to that portion of the story to what the talking heads say about whole life insurance. You see, there are certain types of whole life insurance that you don't have any control over, or there is a very low interest rate and your money is tied up, or it's very expensive, or you don't have any access to it. Some whole life insurance will do that. But there's also whole life insurance that gives you everything that I'm showing you here today, that allows you to do infinite banking, that allows you to have control of your money, allows you to do some of the things and examples that I'm about to show you that we've done for our clients and that we're doing for ourselves, and that you could be doing if you see yourself really taking control of your money. All right, let's move on. The key is having your money grow through uninterrupted compounding. Uninterrupted compounding is very important to understand when it comes to this process and how you can become the bank through this concept. Here's just a simple example of it, showing uninterrupted compounding using a penny that doubles every day for 31 days. You started with a penny and it doubled to 2 cents the next day, 4 cents the next day, 8 cents the next day. To day 31, you would be now at $10,737,418. If you had that uninterrupted vehicle that allowed your money to simply compound every day without being touched. This is what is available to you within the types of whole life insurance policies that we're talking about here, versus an uninterrupted situation where you have the money into it that may compound for a period of time, and then day 23, life happens. Car breaks down, gets in an accident, the house burns down, or didn't have something to protect me to replenish that money, and I got to start over. Well, in this same example where you had over $10.7 million, That same example through an interrupted compounding period would now be $2.56 if it happened on day 23 where you had to start over. So understanding compound interest is a very important key when it comes to your finances. It also is very important to understand this if you're investing in the market and you're looking at or hoping the market is going to give you a certain return that is uninterrupted. There is no such thing on the market. Markets always have interruptions of compounding. Now, it may come back to a period of value over a period of time that we talked about a little bit earlier, what that would take. But the point is, you can only get uninterrupted compounding in the vehicle that I'm showing you here today. It does not exist in any other vehicle. This is very important. So let's look at an example here. We like to call this story the Mark and Joyce story. It's a typical American family. They were 37 and 35 years old. They had 3 kids, 3, 4, and 8. Monthly income was around $7,000 or so between the two of them. They had less than $100,000 in their 401k at this time. Their main areas of interest was increasing retirement income, reducing debt, getting spending under control, increasing savings, college planning, and doing wills and trust. Now, under their savings investments, they had a Bank of America emergency fund of $6,000, where they were earning 0.2% interest on it. Then they had a Fidelity 401k from the job, where they had an account value of $36,500. Monthly contribution was $300 they're putting in monthly into that 401k. They were earning approximately 5% at that time on that. Outstanding debts, they had Visa, interest of 12%. Payment was $460. I'm sorry, the balance is $460 with a payment of $55. Medical, dental bills, wasn't being charged on interest on that, but the balance of $24.20, they were making a payment of $200 on that. Discover credit card at 16%, balance of $4,200 plus, and the payment of $296. Furniture bill at 18%, at a balance of $5,988 with a payment of $237. The auto loan they had out, 8% auto loan at a balance of $13,313. Payment on that was $417. Mortgage, they had 6.5% interest rate on their mortgage. Their balance was $152,935 with a payment of $972. So their total debt, when you look at that, if you totaled up their balances, they had a total amount of $179,352 as a balance. With payments they were putting out was $2,177 monthly for their debts. Average interest rate was 10%. If you total all that up and make an average of it, it was 10%. But we look at the real debt situation in this particular example, or with our clients, we want to make sure they understand what the real debt was when you apply interest to that and the time of interest going out. They had 29.5 years that it would have taken them to get out of debt that kept making those payments on schedule. That's $179,252 debt balance, $194,988 in interest payments. Their real debt, if you applied the balance and the interest that would be applied to it, was $374,340. More than what the doggone house was valued at that time. Their current retirement plan, $36,500 in there. They had $300 monthly that were putting in contributions, 5% annual interest rate. They were on a 25% income tax bracket. Their retirement account at the end of the savings period over 30 years, before tax, they would have $408,890. After tax, $306,668. But let's look at what Mark and Joyce were able to accomplish with a banking system. They were free from lenders in 7.9 years versus 29.5 years. They saved $116,743 in interest. They freed up that $2,177 a month for retirement, saving them in 29.5 years. If they kept putting that money into their plan, they would have over $1 million available to them they can use for whatever purpose they wanted to. Powerful. The current retirement plan was at $306,668 after taxes. With the banking system, they went to over $1.1 million, tax-free for retirement. Imagine yourself seeing those numbers for yourself in your own individual situation, because everybody's different. But it doesn't matter what these numbers are. It's about where your numbers are. This is very powerful. I'm going to get a little more in depth there with you and show you how this can work. And I'm going to show you an example. We're going to go under the hood, so to speak. And here we're talking about getting all the money back that you pay out for cars. Remember I said 75% of all the interest you pay out goes toward cars and mortgages. Let's talk about the cars here and how buying cars can actually give you a vehicle or give you a tool when you understand banking of it can actually create wealth using this system. I'll show you this little example of how this can work for you. And we're going under the hood, so to speak, like I said, using this dividend paying whole life insurance policy. This is an illustration of a policy, and we're going to just give you the components of it. Take it step by step here so you don't get lost on the numbers. Don't worry about the numbers. Understand the concept. But here you have premium payments that go into it. In this case, this is the premium payments that you put into the policy is your deposits that you're putting in. And we like to call the policy the bank, so to speak, because it is a bank when you understand how to use it. So we're making premium payments or deposits into the policy or the bank. In this case, $10,000 a year for 7 years is what this particular example is doing. Okay. The age doesn't matter. That's why it's grayed out here, as you see on the screen. Because when you understand banking and understand how to use these policies, it doesn't matter where you are 75 years old or you're 25 years old. It's about how much are you going to apply toward the system for that money to work for you within the system. Your age has nothing to do with it. However, what will change is the death benefit based on your age, because it is insurance. Your age and your health can determine what that death benefit is going to be. If we need it to be higher, we can adjust. If we need it to be, if we're not worried about that and we want to concentrate on the cash, which is what we're doing here, it can be lower. So it's grayed out here because it's not important. What's important is how your cash works inside the policy, right? So let's look at this in a little more detail. In this particular case, this person is going to purchase a vehicle for $25,000 in year 4. Now, we would never tell you to wait 4 years to use a policy. We want you to use that policy from day 1. Okay? As soon as you possibly can use it, we want you to use it and start understanding and how to pay yourself back with interest for using it. But for this example, for the sake of this example, we're showing it in year 4 that they're paying for a $25,000 car at that point, just because we're doing cars, okay? And they're setting aside a $500 a month payment that they're going to put back into their policy. For borrowing against their policy, they're going to say, okay, I'm going to pay myself back $500 a month because that's what it would have charged me if I'd gone down to the bank and got this same loan. Okay, so I'm borrowing it from my policy to use it to purchase the vehicle, all right? I'm making premium payments. And so, well, first off, that totals over that period of time for that 5-year period, we're paying into this to pay this off. We'd have $30,000 that we'd have paid into the policy at that point. Okay, those are the payments for the purpose of using the car. Now we have premium payments for 7 years. We've put in over the first 7 years, we've put in $70,000 into this plan. We bought the car at $25,000 and made payments back to ourselves for 5 years, $6,000 a year or $500 a month, which totaled $30,000. You add those up, you got $70,000 in premium, $30,000 in payments. That's $100,000 that you're in to this policy in terms of money you put in. You paid out $25,000. So your actual amount or actual balance versus your money you put in versus what you put out in the policy is $75,000. But now look at your cash values here. Right now, your cash values have grown to $73,226. That is a 97.7% recapturing of interest that would have been paid out to others. So basically what happened here is that you bought a car for $25,000, but you just got back 97% of the amount that you paid for the car. So now you have $73,226 in your account, and you have a $25,000 car that you've paid off over that period of time. You actually bought it cash and paid yourself back to pay it off within your banking system. Well, let's keep it going to where you duplicate this process the next 5 years. You do the exact same thing, buy another $25,000 car, and you pay yourself back over 5 years, $500 a month, back into the policy that you borrowed from to buy another car. So right now you've put in $130,000 total over this showing 13-year period of time. You've taken out of that $130,000, $50,000 to buy 2 cars. In your cash values, you would have, actually you're into this now, $80,000 total because of the amount you've earned, the amount you've put into it versus the amount you've taken out. So you're into it now at $80,000. Your cash values have grown by $22,571. Or another way of saying that is that you have recaptured 119.7% of all the money that you paid out to buy the 2 cars. So now you're up 119.7%, and you have 2 cars that you own. You also have $95,797 in cash that you can still use for whatever purpose you want to. Now, I'm just using car, a very inexpensive car these days, in this example. Picture this being your mortgage, or picture this being the investment property, if you're into investments. Picture this being the business that you wanted to start. Anything that you feel like you wanted to use your money for that purpose in order for you to create wealth for yourself, it can be done using this concept and this process. See, this allows you to be able to be at a point where you are using the money over the period of time that you are accumulating the money versus waiting 30, 40 years, whatever that time period is that you put money into a 401k, IRA for later, to use it later while you're accumulating it to put it somewhere else, hoping that it's going to be at a certain value at a period of time. Everything that you see here on this screen right now is guaranteed to happen. It has nothing to do with the market. This is simply understanding banking and how banks work and using the proper vehicle, a whole life dividend paying insurance policy from a mutual company that will allow you to do banking. This is what you can accumulate. This and more. So the values don't matter. People ask the question, well, how much do I have to put into this? Do I have to do $10,000 a year? No. Whatever value works with you and where you are today, that works. We've got clients that put in $500,000 a year. We've got clients that put in $300 a month, $3,600 a year. Does not matter. They all work the same, and everybody's happy with it. Okay. Here's another example here. There's a real life client here where this is a report that we used to give out. We give a different one now. It's very similar. It's just a little different. But I'm going to show you how this works and what's very important to capture within really understanding what is being done for these clients and what can be done for you. In this particular situation, their current, if you look here on the left, it's the current financial path, debt-free in 299 months or 24.9 years. They were at a point where it's going to take them almost 25 years to get out of debt. Okay, the total interest they're going to pay out is $171,815.66. The volume of interest is 56.03. What is volume of interest? Think of volume of interest as that hole in the bucket when you have debt. So you might be saving money somewhere and you might be earning 20% on the money that you're putting somewhere else, or maybe on the market, or maybe in any particular situation. But you're in a situation where you have debt and you're paying out interest. The volume of interest is telling you that in this particular case, this client was realizing a 56% volume that was going out. So it didn't matter what they were earning. It was 56% of it is going out. So if they're earning 20% somewhere else, they're actually only realizing a negative 36% return because of the volume of interest that they have with their money that's going elsewhere. Okay. Total dollar-wise, $478,444. But that volume is what's most important. So with the private banking system, they went from 29 or 24.9 years of paying off their debts to 4.5 years. Their volume of interest went down from 56% to 10.1%, saving them 20 years of paying debts and interest to someone else, where they now recapture that money in their own pocket. If you look down at the green line there, which says net worth increase, they were able to increase their monthly savings by almost $3,000 a month. Their total savings, if they kept doing this plan or keep doing this plan, which they are doing this plan and very happy with it, they're now at a portion where they know they can realize over $734,000 by simply doing what they're already doing, just adjusting how they pay out their money and capturing and understanding that they can be the bank. They can capture that volume of interest rather than giving that volume of interest out to other people. Let's get a little bit more in depth here and show you the actual roadmap of that situation. So here we have the balance is where they had a card at $595.98. They had a second card at a balance of $7,500. They had a loan outstanding of $21,200 some, another loan at $6,035, and a mortgage at $271,000 and some. Okay. Months to pay off, basically it was 2 months for that first car, 8 months on the second car, 4 months for the loan number one, and 7 months for loan number two. It would take 54 months for the mortgage to be paid off. And it gives pretty much exact time frames of when that would actually happen for them using this roadmap. Okay. Here we get down into the numbers here, and just want to go through this with you real quick. If you see it in green, that is the time period of where something was paid off. So in this case, 2 months later, they paid off car one, as you can see. What they did then is took that car payment that they were paying and now applied that car payment to the next debt that we were going to capture. And that was, if you see it in yellow, that's additional payments going toward the second debt. The second debt that we were paying off was loan number one. So they had the car paid off in the second month and then applied that additional to the loan number one, where they continue to make their regular payments with any other debt, and everything else was being paid off. Now, June, additional payments being made. You see it being highlighted. An additional payment, because they paid off the car number one, they're paying that additional, still goes into that loan. Just continue to knock that down, and everything else they're making regular payments on. July, they take a loan against their policy or their bank for $15,492.33. And now that is applied to pay off loan number one. So that has been paid off now in 1, 2, 3, 4 months. Actually, I think that was 7th month, at the end of 7 months. That one is paid off. And everything else, we continue to make additional payments to the loan number two now, because they've paid off the car plus loan number one. Now we're applying those additional payments to the second debt that we're going to knock down, and continue to make their regular payments on the mortgage. Next month, just showing additional payments that will continue to being made from the other debts that were paid off, going into loan number two now, because we're capturing, starting now to pay off this debt as we go forward. And you can see these payments that are continuing to be made to knock these down on a monthly basis until we get now to November of that year, 2022, where they took another $15,492 and applied that toward the car number two to pay that off, and applied the difference to the mortgage to start knocking the mortgage down. And this continued until the mortgage was paid off. Every quarter in this particular example, they took a certain amount from the policy, applied it toward the mortgage. Every quarter, certain amount from the policy, applied that toward the mortgage. Certain amount from the policy, applied it toward the mortgage, until in September of 2026 is their schedule. If they keep with this schedule, their home will be paid off. And it tells them exactly the amount that they would apply toward the mortgage to pay it off and what that last payment will be. How do you think this family felt or feels knowing that this plan is working for them, to where they thought, wow, it's going to take me 20 something years? I don't even think about, people don't even think about, you get a mortgage and you're thinking, oh, a 30-year mortgage, no big, you just got to make the mortgage payments, we'll apply a little bit to it. Don't even think about, you can get this thing paid off in 4 years. How do you think they felt? I can tell you how they felt. They are absolutely ecstatic, to the point they're one of our agents now. That's how serious this is. Because they know what they can do for their family, and they know what they can do for others, their other family members and friends that they have. That's what this is all about. Now, this is just showing you debt. I've given you an example of having debt and how you can take care of that, how you can create wealth with the debt. Remember, I said this client would have over $700 and some odd thousand if they kept putting the money into their own plan. Now, that $700 and some odd thousand is not money that they had to wait or have to wait 20, 30 years down the road to realize. They're realizing it every step of the way. Because now they can go and say, well, you know what? I want to start this business for my daughter, because that's what they did. They bought some equipment for their daughter to have a printing system because they wanted to make T-shirts. They also have a trucking company that they work with, that they own, I'm sorry. They can now go purchase some additional trucks to expand upon that trucking business because they understood this process. That's what's powerful with this. It's all about understanding how to become the bank. So let's look at a comparison real quick. It gives you guaranteed predictable growth. Everything I talked about here is guaranteed. There is no, well, if this happens or if that happens, it's going to, no, it's guaranteed to happen. You do what the process is going to do, what it's supposed to do. Can't get that in 401ks and other government types of programs to defer interest. You can't get it in IRAs. You can't get it in a Roth IRA. It only happens within a banking system. Locks in your principal and growth, even when the market crashes. You're not going to have that happen for you in any type of government plan that's investing in the market, but you have it here in the private banking system. Gives you control of your money without government restrictions and penalties. It's not going to happen in 401ks, IRAs, Roth IRAs, but it can happen here in a private banking system. Gives you tax-free retirement income. Doesn't give that to you in 401ks and IRAs. You can get in a Roth IRA with limitations, of course, if you can put money into it. You're absolutely going to have that happen in the private banking system, and you can use the money. It's not locked in. Lets you use the money in the plan without penalties, however and whenever you want. Not going to happen in 401ks and IRAs or Roths, but you can use the money anytime you want to in a private banking system. Lets you use the money in the plan, yet still have it grow as though you didn't touch it. That's that uninterrupted compounding that I talked about, where your money is in the cash values of the policy. When you borrow against it, you are borrowing against the general fund of the insurance company, and your cash is consistently growing with interest and dividends uninterrupted. That is the power of infinite banking. It only happens inside of a dividend-paying whole life insurance policy that's structured for banking. Allows you to fund it every year without limits imposed by the government. There's no limits here other than the actual limits of the policy itself. And once you reach that limit within a policy, you can always create a new policy to where you have multiple, what we call multiple banks, because you're basically owning banks. You can create as many as you want to. Nelson Nash, that I spoke of earlier, he was the writer of the book, Becoming Your Own Banker. Created the concept. He had over 50 some odd policies at some point in his life. As he got older, powerful. He understood this process. Finishes funding itself if you die prematurely. None of these can do that except the banking system, because it is life insurance. It has that component into it, what we call a self-funding process. Something happens to you, your family gets all the cash, the death benefit and the cash that continues to grow. Lets you know the minimum guaranteed value of the plan on the day you expect to tap into it and at any point along the way. You know predictably what your money is going to do every day, every year, every month, at any time that you need it. You already know because you can check on it every day if you want to. And it doesn't go negative. No such thing. Private banking system, the only thing that can allow that to happen. There is no other vehicle that does all these things that I'm pointing out to you today, guys. There just isn't. So what are the next steps? The next steps for you is to find out how this will look for you. Whether you do business with us or not is irrelevant. What I would ask for you guys to do is to find out for yourself what the numbers for yourself and your family would look like through requesting a data sheet. Request the data sheet. I'll get that sent out to you. You take the time to fill that data sheet out. Basically, that is just asking certain things of what your debt situation is, how much you're saving now, where are you saving your money now. And what we're looking for is a way of showing you how you can redirect some of the things that you might be doing right now. Because most of the clients that we work with, they are doing something. We're just going to show you what we believe is a more efficient way of doing what it is you want to do, whatever that might be. And we find that out by you filling out that data sheet, okay? You request that data sheet by simply sending me an email at info@legacyprivatebank.com. I'll email that out to you immediately. As soon as you get that back to us, we'll give you a report that shows you what your numbers look like. We'll talk about it. If you decide to do business with us, great. If you don't decide to, at least you know, hey, I looked at this and this is what it could do for me. I just wasn't ready to do it. Fine. But find out what your numbers are at least.